This is Caroline out of Princeton, New Jersey. Wants to know what's happening with burgers. What's going on with Wendy's? We got an opportunity here.
Oh, I love Wendy's. I love Wendy's because, first of all, it's at a really low price point. So that means that even folks with smaller portfolios, because we always want to evaluate how much risk we're opening ourselves up to, and then size our position accordingly in our portfolio so that not one position can take down our whole portfolio. Risk management is everything, right? And so I like Wendy's because it's really affordable. It's something that people with smaller portfolios, whether you're using the actual stock, shorting or going long, or whether you're actually using substitute options to get your initial covering position in place. Listen, I'm seeing what you're seeing in Wendy's, I think. And I love Wendy's as a company because they're always bringing in positive earnings. They're giving a nice, healthy dividend back to the investors. The investors aren't going, I love sideways, choppy symbol patterns. And so the investors, because they're getting that nice, juicy dividend, aren't really going to be pushing on the company to get asset appreciation. So it's going to stay sideways for a while. That's why it's always been in my portfolio. But right now, I'm seeing this double bottom forming on Wendy's. And, you know, maybe about a week ago would have been our best opportunity. I see, the fast MACD gave me an end of day signal, and there were these 2 days right after during the trading sessions, February 18th, February 19th, which real optimal opportunity for me to have, gotten my covering position in place, either buy the stock or buy the substitute option. At this point, it's appreciated a little bit higher. And um, if you're in that initial covering position, I would actually be now looking for whatever signal you use to think about selling that premium. So when I'm talking about selling premium, I'm talking about selling a near term, expires in the next 3 to 5 weeks at the money option, and then taking that money and using it to subsidize a protective put option 3 to 6 months out in expiration down near your break even price. So, selling the 16 near term option and then buying maybe the $14 uh, 3 to 6 month out option, and using that little range that you've just created to basically let time decay work for your benefit. The fact that options are wasting assets. So I guess let me sum it up. If you got into that initial covering position a couple of weeks ago, then great. You're poised to sell premium, buy protection, and turn this into an income generating position. But if you miss that opportunity, then I would actually be turning my eyes to, you know, where's the reversal down, and should I be shorting this stock or buying a substitute put option? That's kind of where I'm seeing it. But now with kind of the supercharged power of HEMA, let's see what she says.
Sure. So ticker WEN. And basically, I agree that it was a few days ago that was probably the better time to take advantage of this upward move. And actually, the RSI power zones get a great defensive signal. So if you had been short at all along the way, they give a great defensive setup that my more advanced education after that ebook gets into. Like, what's the pattern? Is it offensive or defensive? How exactly you set it up, what kind of entries and stuff.